super excited to get started. So
Yeah, let's do it.
we have an amazing individual, Emma Clark, for this month's Early Bird Family Finance webinar. And Emma is the COO over at Sweater Ventures. That is a investment firm based in Denver or Boulder, Colorado. And it's a really unique model, which I will let Emma explain in much more depth. But Sweater actually is an investor in EarlyBird, which is really exciting, and it's been a wonderful relationship. And today, the goal is to really dig into all things investing in private markets and what that really means. You know, what does it mean to invest in a startup? Why do people do it? How do we do it? It feels like it's always something that maybe is far away from what is possible, and really just giving, you know, some guidance and answers around what is the importance of investing in an earlier stage company and what's the reward as well. So thank you so much for joining, Emma.
Yeah, I'm happy to do so. And I'm glad. I'm also an early bird customer myself. I have a 20-month-old, and we're big fans of the early bird app. So not only are we investors in early bird, but I also have just been a big fan from the beginning, and I'm excited to continue to use it. And when we have another one, to put them on the platform and invite my friends and family. So when you guys asked me to come on, it was meaningful for me, not only because we're investors, but also just because I've just been a big fan of what you guys were doing in the market from the beginning, for as a user and as a parent as well.
Amazing. Thank you so much. So would be awesome to, I think, kick it off with a little quick introduction on yourself, and then really giving us an overview of Sweater Ventures, and the amazing work you all are doing.
Yeah, happy to do so. So like Jordan mentioned, I'm the COO of Sweater. Sweater is, our mission is essentially to make venture investing accessible to anyone and everyone. I've been with Sweater for about 2 years. My background is mostly in early stage startups on the operating side myself, out fundraising, as well as running some earlier stage businesses. So I've been in fintech and finance for quite a while. Moved over with Sweater because I really believed in the mission and what we're building. Like Jordan mentioned, we kind of have a unique model of venture investing. So essentially what we've done is create a fund structure and a platform where anyone, regardless of whether or not they're accredited being, you know, amount of income or wealth status. Normally a venture fund, you have to be accredited to invest into that fund or individual startups. But we've created a fund structure where that is not the case. So part of doing that was this belief that with education, with resources, that anyone should be able to invest into private markets and into this asset class. So when we talk about this webinar and investing into the private markets, you can think about investing into real estate or art or private credit or private debt. But one of the ones that you'll probably see in your research, or if you've heard anything around investing into venture, is investing directly into startups. And so that's what Sweater focuses on. EarlyBird is one of our 30 portfolio companies. So what we do essentially is pool all of that money from individual investors. We pull it into a fund, and then we deploy that into individual startups, just like any other venture firm. So we fully manage that from the due diligence process, you know, sourcing the companies that we want to invest into, running due diligence on them to make sure they're good investments, and then working with the individual portfolio companies as well throughout their life cycle. So that's kind of what we do in a nutshell. We believe that VC's historically been a pretty closed door ecosystem, and our mission is try to change that for individuals. So we have one fund right now that we opened up called the Cashmere Fund. That's our first fund, and we invest into all sorts of different companies. So yeah,
amazing. So from the most kind of layman terms, walk us through the journey for a parent who maybe is, you know, pretty new to investing, period. You know, let's take myself as a user persona. So maybe I just opened up my first investment account with Robinhood. I just learned about EarlyBird because I had my first kid, and so I'm just starting to put away maybe $50 a month. And now I'm getting more exposed and interested. I'm searching for more things and how to maybe put my money more to work.
Yeah.
Walk me through kind of how even
To think about that.
to even start thinking
Yeah,
about
yeah.
that, and where Sweater maybe comes into play and how that looks from a
Yes.
user journey.
Yeah, that's a great question. So I mentioned accreditation, and that's kind of where it starts. So if you think about kind of asset classes that you can invest into and where you can put your money, traditionally the most accessible is the public markets. So you put your money into an account, maybe it's an EarlyBird account or you're on Robinhood, and there's some level of managing that, or you can decide which stocks you invest into yourself. Investing into private companies, which we consider just part of the venture asset class, itself is really mostly for accredited investors. So I'll break that down first. And I say mostly because these are kind of historical SEC rules that were created many years ago. Accreditation was the SEC's way of saying, hey, we've highly regulated the public markets. We can keep an eye on those. We know what information is being put out there to individuals. And so for private companies, there's not as much regulation put on the information that they provide to individual investors. So we only want those that have a higher level of income or a certification, a series license, to actually be able to invest into those companies. And so traditionally, if you wanted to just go and say, hey, I have a friend, my friend started a company, I'm really interested in it, I'd love to buy some shares in that company, you really can't do so unless you're what's considered accredited. And so accredited means that your annual income is above $200,000, or your joint combined income with a spouse is above $300,000, or you happen to have a cool $1 million sitting on the sideline outside of the assets in your home. So most individuals in America, that is not the case. There are a few exceptions if you're looking at the landscape. So you might have, like if you've ever watched Shark Tank, you've seen Kevin O'Leary started a crowdfunding platform where individuals can go and find companies and say, hey, through this regulation called the regulation crowdfunding, Reg CF, you can actually invest directly into those companies.
And what would be some examples of those if people were interested?
Yes, you could go to Republic, you could go to WeFunder. Those are great examples of places where an individual company goes in and says, I'm going to go through the process of listing my offering to the public on one of these platforms. They can't go directly to you and do that. They have to go through the platform. There's a lot of regulation around it. And for a founder, it can be a little difficult to navigate that process. We actually just did it at Sweater ourselves for our parent company because we wanted to provide an option for anyone to invest into our parent company. That is an option. So that's one option if you're unaccredited. So that's kind of the unaccredited pool. If you fall under that $200,000 in income, you can go to one of those crowdfunding platforms. Pros to that, you can go and look at all of these different companies yourself and choose which ones you want to invest to. Cons to that, you then need to be comfortable assessing if that's a good investment or not. And from a diversification standpoint, I also believe that you need to be willing to put in money into enough companies. So just the law of how the numbers work in VC and private companies in general and startups is that most of them end up failing. It's just the reality of how the numbers work. 8 in 10 companies end up failing. And then usually, one of the 10 does okay, and the other one of the 10 might do a little better than that. So you need to feel, one of the things is, are you comfortable going and doing research? Are you comfortable, looking at the companies in that platform, assessing, maybe it's something in an industry that you work in, and so you know it really well. And so you can say, yeah, I feel comfortable going and putting money into that company. But then the question is, can you put aside a little bit of money to put in maybe 5 to 10 companies to diversify your risk? So that's an option for unaccredited. If you're accredited and you have, you meet those qualifications, you have a few more options. So typical venture capital funds, the ones that pool money together into a fund and say, hey, I'll do all the work for you. Most VC funds are structured this way, where they say, I'll source the deals, I'll run the due diligence, manage the companies. They only allow accredited investors, and normally, because they're capped at the number of investors they can have in a fund, they normally only allow really high net worth individuals or institutions like a university endowment, right? Let's say it's, the University of Colorado has an endowment and a bunch of money that alumni give, and they put that into venture capital.
Yeah. So even if you had this money somehow,
exactly,
it's not very easy to get into.
It's hard. It's really hard to get in. Like the everyday person, myself included, can't get into a traditional venture fund.
Yeah.
And I've kind of been in the industry too. It's really difficult.
And some of these funds, just so everyone knows, on the venture side, right? There's the large names out there like Sequoia or Tiger. These are companies that, luck may play a little bit of a role, but as Emma said, right, you're diversifying, investing in hundreds of companies, and then you get the Uber, the Airbnb. But for every Uber car transportation company, there were hundreds that failed, right? So these companies then, of course, are successful. That's why you know those names. But then there are other tiers of VCs that are, less. I mean, with not as large of a brand, but that still have that limitation that not everybody can get involved because I don't have a cool $1 million sitting on the sidelines, as Emma said, and I don't think a lot of us do.
And they can only allow 99 individuals in, and so if they can only allow a small number, they're going to only take big checks.
Yes.
So then your last option is, if you are accredited, is you actually can invest directly into companies, and so. A lot of this, we see this in really early stage companies will open up a friends and family round. They're looking for angel investors. An angel investor is essentially just someone in a very early stages of a company that says, I'm going to put money directly into this company. I believe in it. Often they're involved and they might be an advisor, or they're just sitting on kind of with the cap table, the equity stack, and they're putting in enough money for that founder to feel comfortable that they're a benefit to the operations of the business.
And what kind of check sizes are you generally seeing in that?
Yeah, that is, it really depends on the round, but I'd say that most founders, to feel comfortable with having, not having hundreds of people on their cap table, and I say the reason cap tables matter is because it's actually just a lot to manage in terms of the number of equity investors you have in a company, and founders are already pretty squeezed in their time, and so sometimes they'll say, we only are going to allow someone in if you're going to write a $10,000 to $25,000 check. So that's pretty common. Sometimes an individual will pull together what's called a special purpose vehicle, where they say, hey, I'm going to grab all my friends together. You each can throw in $5,000. I'm going to lead the special purpose vehicle. It's going to show up just under my name on the company's cap table, and I'm going to take a fee on the money that you put in since I'm managing this whole process. So you might have a friend who's interested in this and says, hey, I have a deal for you. I'm going to pull together an SPV. That happens as well in the industry. But again, what I'd say is, for the everyday investor, like, that's very much, who do you know? Do you happen to know someone in tech or someone in venture? There's some nuances to it. It's not easily accessible to everybody out there. Is what we found. So,
and another interesting resource along those lines on the special purpose vehicle, also known as an SPV. You might have heard those three letters put together. An interesting resource to look at is called AngelList, which generally has a lot of consolidation of these angel investors that create these groups and then invest in startups. So it's another interesting resource. So basically, for access, you have crowdfunding, which you can look at Seed Invest, Republic, WeFunder. Definitely a very difficult model to invest in because it's, although they do their due diligence, it's still, the success rate with those platforms is unfortunately pretty low because of just the general success rate of startups. Then you have kind of the angel investing SPV world that you still do need to be accredited, but it's a little bit more accessible. And then the third is a new model that you have.
That's us.
And so talk to us about how that looks, and then again, how just one of us would be able to get involved.
Yeah. That's a great question. So Sweater was started with the journey of saying, if the only option to an unaccredited investor is to go the crowdfunding route, that's not good enough. This isn't to say anything bad on crowdfunding, but it's just the realities of being a parent, being a full-time working person, just anything, the complexities of life that come along. It's hard to put aside the time to do due diligence on every single one of the companies that you're going to invest into. And so Sweater created a fund structure, unlike other venture capital firms, where an unaccredited investor can put money into the fund. And so we opened that up to unaccredited, and accredited investors can do it as well. So the value proposition for us, for someone who's not accredited, is great. You can put in as little as $500 and as much as 5 million. There's no cap, but we started as little as 500. And then we essentially pool all of that money from individuals, thousands of individuals together. And then we manage the process of making the investment. And then we bring people along the way and say, hey, here's what's happening with your money, right? Here's what's happening with the investment in EarlyBird. We had an event out in New York last week that Jordan joined us for, where he gave an update to some of our members on what's new with EarlyBird and what's happening with the investment that they've put in to EarlyBird, the company, right? And we try to bring people along on the venture education piece as well. The value proposition for accredited investors is, again, you might not have the resources to find individual deals and may not have enough money to get into a different venture capital, fully managed venture capital fund that has a limitation on the number of investors they can have. And so for Sweater, that's not a concern. You can also put your money in, and then our plan is, you put your money in, we'll invest that into startups, and then we'll start to also offer individual SPV opportunities like Jordan talked about, where you can kind of double down and put more money in if you're interested in that company. So we sit in this kind of middle unique space, which is why it took a while to get this type of fund structure figured out with the SEC, because we've essentially opened it up to everyone. The fund is open forever. It's evergreen. I think about it a little bit like a cousin to a mutual fund. If you've ever invested into mutual funds, you buy in at a share price. And then as the value of those companies goes up or down, the share price goes up or down. So that's essentially how it works.
Awesome. So cool. So
yeah.
And we've been tracking Twitter forever. They have, if you guys have not taken a look, I would highly recommend go look now. It really is a unique model to create an entry point into a historically very closed world, right? So talk to us though now about, okay, so I go on, I put $500 in, maybe I do it reoccurring as a monthly basis, just like you would on investing in an ETF. Maybe it's $500 a month, or maybe I put $2,000 in. How do I make money? And what's the upside here? How does it all work? Now that money's in, and I'm like, what's next?
What does this look like? Yeah, exactly. So great question. So I think first it makes sense to talk a little bit about venture returns in general and what that looks like, because I think that there's this perception that, venture is risky. I'm not going to say it's a perception, but there's ways to diversify that risk. And then there's ways to talk about why it's worth it to diversify some money into venture because of the potential returns. And so I think the first thing I'd say is, so you put your money in, and then what essentially happens is we put that into a startup. We then own shares in the startup. And then when we look at the trajectory of that company over time, there's two ways that they can exit for us to essentially make money on that investment. And then that money, that income that we make, is returned to all of our investors into the fund once that company exits. So I'll talk about that first. I think that's fundamentals, and then talk about how that translates into historical returns for venture and startups in general. So the two main ways that companies exit, when a VC makes money, they're essentially saying, we own equity in this company. When they exit, they can do that through two main ways. The first is a lot more common than people really hear about. You all hear about IPOs, but really it's getting acquired by another company. Acquisitions are the most common way that a company exits. And when it comes to venture returns, that's a very profitable way for a company to exit. Not every company is ready or will get to the size of an IPO. That doesn't mean that it's not a good investment. So the second, as I mentioned, is their initial public offering on the public markets. And one of the reasons that also produces its own liquidity event, as we call it, or an exit for the company. And then cash is then returned to the venture firm, and then it's returned to investors. In a traditional venture fund structure, most VC funds take what's called a 2 and 20 on that, in terms of like, what fees does an investor take from you as an individual putting money in their fund. Usually that means they take 2% of the money that you put in the fund, and then they take 20% of the profits when that company exits. So for example, if company ABC, we invest at their seed, very early stage, they go along and they get acquired by a company 3 or 4 years later.
Not to interrupt you, but
no,
let's take this example very, very concretely.
Yes.
So company A goes and raises their first round. It's called there's a lot of different rounds for everyone, right? You could do a friends and family round, which is really, really early. That's like the idea phase. And then you could do a pre-seed round, which is maybe you just got out to market, but you still need some money to keep going. Then you could do a seed round. That's kind of the established, like, first real round for a real startup. And then you have the Series A, Series B, Series C, and then at some point you either get acquired or go public. So let's take it at the seed round. Company A is worth $1 million. They're saying that's our valuation. Sweater comes in and invests $100,000. So you guys get 10% of company A. Then continue to what? So
and then what happens? Exactly. So then we own 10% of company A. Company A then continues, it grows, it raises another round of money. And it might be that we put more money in, but other investors might put more money in. And as they put more money in, that can dilute our investment. However, company A also might raise from, I think you said $1 million, they may raise to $3 or let's say $10 million at their next round. So the value of our equity is increasing, even if more shares come into the company to dilute that value. And so your hope, and this is generally what happens, this is what happens with companies that have a successful exit, meaning a multiple return, is that that valuation increases enough so when they exit, even if my initial 10% gets diluted down to 1% over time, that 1% on a $1 billion company is a massive return. And so over time, that's essentially how the equity stack works, is what it's called. And I'm glad you backed that up, because in any industry, you kind of, there's jargon.
Of course, there's so much. And so, and just to actually wrap that one up. So as Emma said, right, so it was $1 million valuation, and then we raised our Series A to $10 million valuation. So that $100,000 that's what I invested, that you all put money in, is now worth 10x almost what it was put into, right? And then now it's Series A. This company A is really flourishing. Let's say we're a financial technology company like EarlyBird, and some of the massive companies out there in the world, like Fidelity or Vanguard or Citibank or any of these financial institutions, that go, oh wow, EarlyBird is such a great company helping young families start investing. We don't do this very much, right? We don't have access. They built this whole brand. They have this great user base. We believe if we bought them and brought them into our ecosystem, it would make us a lot more valuable. So then they would come to company A and say, hey, we will buy you guys for $50 million. What do you say? And company A will then have to decide, is this worth it at that point, or are we worth $250 million because we're growing so fast and so exciting? Or, oh my God, this is an incredible event. This is the time to do it. There's a great partner. Let's say yes. And if we say yes, that's the liquidation event, right? Now we get paid that $50 million. Sweater makes out for almost 50x their original investment, and then that's distributed back to what are called LPs, which are you all that put money into it, and you see a really exciting return on your investment over time. Now, I think one of the really important things, Emma, is time duration. What have you seen and are talking about to people that put money in? Because this might not be in 12 months. What's the kind of general thought process as you're making investments?
As we talk to individuals about it, be prepared to have your money in for 7 to 10 years. And it's not right now, the average, companies are staying private longer. And so the average time before a company exit is increasing, but which sounds like a bad thing, but it's actually a good thing if you're investing in the private markets. And I say that because right now, venture has produced historically larger returns over time, even, so let's say post 2007 to 2022. So post the last recession to today. Venture capital returns exceeded the public markets by 55%. So whereas you could get a 5x return on average by investing into venture, you could get a 3x return by investing in the S&P 500. And so what that actually means with companies staying private longer is if you're not in the private markets, you're losing out on that, on kind of capturing the value from those high growth years. So companies like Rivian, the electric car company, Coinbase, Lyft, Uber, these were all companies that had massive returns for venture capitalists and the investors, the LPs, their limited partners, the people who put money into a fund. They had massive returns for them, but they had kind of lackluster post-IPO performance. And so what we've seen is that as companies stay in the private markets longer, if we can get individual people access to the private markets, they're actually capturing a lot more of that value, and that's not just reserved for wealthy individuals. Yeah, so that's a piece of it. And I think there's one thing, I know we're almost at the end, but that I think is important to touch on, Jordan, around kind of returns. And it's like, great if you can get a unicorn. So unicorn is a $1 billion valuation. You may hear that used in anything from New York Times articles to TechCrunch articles. Most venture company or most startups do end up failing. And so the typical venture portfolio looks a little bit like this. It's basically 50% of the companies in a portfolio return a loss. 25% of them will return kind of 1x, get your money back. Around 15% of them will get a 3x return. And then the last kind of 5 to 7% is really where you're relying on these outliers, these companies like company A that we just talked about, or Uber or Lyft, to do so well that they are kind of they're pushing up the returns of the entire portfolio of companies. Yeah. And so I mention this because one of the things that we fundamentally believe in at Sweater is that having a broad portfolio that invests, that puts a lot of bets into a large number of companies is how you actually get to diversifying that risk of only ending up with the 50% that return a loss or those that only return 1x. Yeah. Because if you put your money in a bunch of different places, just like indexing any sort of market or putting in an ETF or putting it in a mutual fund, essentially what you're doing is diversifying risk. Yeah. And so venture can be a risky asset class. Investing in startups can be a risky asset class because of those numbers I just described. But there are ways to do it through, in our belief, creating a large portfolio of companies where you increase your likelihood of getting one of the big winners, essentially.
Yes. And I think it's really important that philosophy of diversification is something that, of course, we preach all the time at EarlyBird, right? Which is really the philosophy around all investing, right? When you look at your own portfolio, right? Say I have $10,000 that I can invest. You don't want that all in one thing, right? That's why we look at having, ETFs as a segment. If you're feeling on a higher risk profile, potentially some crypto, potentially some exposure to private markets through Sweater, some exposure to maybe real estate, right? You decide to buy your first home.
You look at a REIT. Yeah,
exactly. And so you have this, you're always thinking about how to diversify that portfolio because you're not sure what's going to happen. It's impossible to predict. But the more, the more boats you have in play that are going, the higher likelihood you have of various things hitting and being successful there. So that is, I think, huge advice. And I know we're at time. I have so many other questions. One of them is definitely digging into kind of what is exciting Sweater the most. But I know we're at time. So I would recommend everyone to go to sweater.com. I believe sweaterventures.com. Sorry.
Yes, sweaterventures.com. And then if you guys do have, Q&A, I'm going to throw my email in here at the end too. You're welcome to reach out and ask individual questions. So
yes, that'd be awesome. We will, if people are interested and love this, we will definitely, have Emma back. As I think this stuff is fascinating. Clearly, we're in the startup world, but go to their website. They have their different portfolio companies they've invested in. They do an amazing job of telling the story of these companies, really digging in why they chose a company like this. As of course, there are hundreds of thousands, millions of startups now out there that are all trying to make it, and so it's an incredible selection process for someone like Sweater, or for a firm like Sweater, that is able to look at, how many companies you guys generally looking at per month, I guess now?
Oh man. At least we're probably like at a broad level, we're probably looking at 20 to 30 companies a month. I mean, we're just churning through, it's hundreds over the course of a quarter.
Yeah.
We're going through so many right now just to, I mean, that's an initial look. And then you decide, do they go to the next stage? Do you dive deeper? That's part of building a large portfolio, is you have to look at a lot of companies.
Totally. And so part two of this could also be kind of, what are those stages to get a startup through that?
What do you look at?
Fascinating. Amazing.
Yeah. Happy to chat about that
too.
too.
Thank you so much, Emma. You are the best, and we deeply appreciate it. Thank you, everyone, for joining our webinar today, and we will do it again next month with another awesome guest. So appreciate everyone's time. Talk soon.
Thanks, Jordan.
Bye.
Thanks, everyone.